Right, we mentioned this earlier. Also, welcome back, everybody. Famed activist, hedge fund manager Bill Ackman of Pershing Square Capital Management is here this morning. He is breaking out his plan for Freddie Mac and Fannie Mae this morning. Mr. Ackman, we should point out once again, if you're just joining us, he is currently short both the junior debt and the equity of Fannie Mae and Freddie Mac. He is not short, has no position in the senior debt, but this is a plan that he came up with. He's taken it and shown some people this plan, and as a result, he made those positions back on Thursday. So, Bill, let's talk a little bit more about the plan. You've explained how the plan works, how basically the equity holders would get washed out in this case. They would go to zero. Junior debt would have an opportunity for the warrants. They'd get warrants, so they would have an opportunity to make some of their money back. But this is a plan that it seems to me would make some sense in Washington, especially among people who are saying we don't want to see the government take over the company again. Where have you taken this plan, and what's the reaction you've gotten?
Sure. First of all, this is something that happens because there's bipartisan support and because it makes economic sense. And we tried to, I came up with this idea literally Thursday. On Friday, I was on the phone with a couple of senators on the House on the Senate Finance Committee. I spoke to a Treasury official over the weekend. I spoke to a senior member of the Federal Reserve Bank of New York, and we're going out there now. Now, in light of some feedback I received, I made some changes to the plan. One of the concerns people had is they said, "Look, sounds like an interesting idea. The government doesn't have to put up any new capital. We like that. That's attractive. Taxpayers take minimal risk. But what about the people who bought the senior debt? Who thought it was money good, who thought there was an implicit guarantee? What about the debt that's held by, the Chinese government? What's the impact if they end up with something?"
Right.
Well, no, it's not. This is the senior debt. What happens to the? It's really. I don't think there's a huge constituency for the sub debt. There's only a total of $15 billion of sub debt, and there's $1.6 trillion of senior debt. So obviously that's not a particularly important constituency. But so what we did is I tried to figure out a way where the senior debt holders can get what they bargained for originally. Even though the government, page 1 of every prospectus says the government doesn't guarantee this debt, page 1 of every 10Q and 10K says the government doesn't guarantee Fannie or Freddie's debt. But in light of where we are in the capital markets, in light of the fact that senior debt is held by financial institutions around the country, we don't want to put them at any more risk than they are already. So what do? We put in this standby purchase on the part of the government, which says that you get 90 cents on the dollar for your existing senior debt, you get 10 cents in new common equity, and call it new Fannie Mae or new Freddie. And by the way, if you want to sell it tomorrow, the government stands by to purchase it. Now, the beauty of a 3-year standby purchase commitment on the part of the government is no one will ever exercise it. Why? Because
if it's there, it's good.
If it's there, it's good. It's now an explicit opportunity. It gives time for the equity value of the company to build, and there's a lot of optionality. Every arbitrageur on Wall Street will buy the common stock and pay a premium, right, for the fact that you got a free put to the U.S. government.
Sure.
And I think over time, properly governed, the put will be so far out of the money that the government will end up not having to buy any of this equity 3 years from now.
Are you making a call as to what the structure of the company should be?
The structure of the company should be much less levered than it is today.
Less levered, but should they be private? Should they be?
Yes.
They remain government-sponsored entities, in other words.
I think actually the whole government-sponsored nature of the entity is going to start to fade as the company. The only reason why you need government sponsorship is because you were levered 140 to 1.
Yeah.
Right? so I think
you could take huge risks and have the government be the backstop.
Right. Heads I win, tails the taxpayer loses is not a good structure for business.
Bill, the Journal, and we know the Journal op-ed pages, typically they wouldn't want any type of taxpayer liability for rescuing Fannie and Freddie. So we know where they're coming from, but they want receivership. They're sort of pushing for receivership. I mean, it's not a ridiculous proposal to make. If you want to help your longs, you want to help the country, why not do it without shorting the common? Why not make it look like you have no vested interest in having this happen?
Oh, why do I?
Why even short the common? Why even short the junior debt?
Sure.
Why you're making money all these other places? You'll make money in the long run on other things. Why just get the conflict of interest out of the way and do it as an altruistic philanthropist type move?
By the way, I actually thought seriously about that.
What happened?
Well, what happened is what's happening in my long side of my portfolio, right? And frankly, we need some good shorts because if we want Fannie Mae and Freddie Mac to be vibrant institutions that can write mortgages and help frankly, I think if these institutions were well capitalized and they could write guarantee a bunch of significantly more mortgages going forward. That might actually be the event that stabilizes the housing.
One of your longs has been Target. Are
Yes.
you still long Target? You still
Yes.
have faith in the American consumer?
Yes. But I have some concern about the financial system. I mean, if the U.S. government writes a $100 billion check to Fannie Mae and to Freddie Mac, to the equity, it's a disaster.
Congress
Look at what's happening to the dollar today. Look at what happened to the dollar yesterday. Look, people are losing confidence. They're concerned about what Secretary Paulson's going to do. I think Secretary Paulson happens to be a very smart guy.
That might not even happen anyway. We had Paul Ryan in yesterday saying Congress isn't necessarily going to sign off on equity infusions from the Treasury into to Fannie Mae.
That's the beauty of this plan. It's a way for these institutions to be recapitalized without the government having to write a check.
If these stocks don't keep going down, is there any reason Paulson and other government officials are going to take this act? They won't take this unless it gets worse from here.
The stocks are pretty far down, and I think they're going to continue to go down. I think they haven't reported second quarter earnings yet. Wait till you see second quarter earnings. They're going to be a disaster.
Well, how can we be sure that the recapitalization will provide enough liquidity, especially some of the complex instruments that these two entities have, start to unravel?
Sure. I mean, I think, first of all, the 90-cent number is a bit of an arbitrary number. If you wanted to infuse more capital, you could give the debt holders 85 cents and make 15 cents common equity. That's sort of number one. Number two, the institutions, if you put them in a good capital position, they have a large amount of what I call core earnings power. Right? Their existing portfolio generates a substantial amount of guarantee fees. They're going to be able to write significant new business. You know, when I entered... And I started investing in the stock market. I was in business school in 1990, and it was a very similar period of time to now. It was a time when people lost confidence in commercial banks because of their real estate, really their commercial real estate exposure. And I bought Wells Fargo in October of 1990, and it was the best investments ever made. It happened to be the time I started in business. And my analysis was, while they had a significant hole on the balance sheet by virtue of the write-downs they were going to take on commercial real estate, they had very substantial core earnings power that would allow them to earn their way out of the problem.
Right.
So as long as they had a sufficiently strong balance sheet, they could continue in business. They can earn their way out of the problem. What we're trying to do here is make Fannie and Freddie, put them in a sufficiently strong position that their core earnings power would allow them to succeed. Plus, the reason why we're doing this as all common equity is if they need to raise more capital going forward, they can go to the private capital markets and raise preferred. They can raise new sub-debt.
But do we know what the tail looks like on some of these complex instruments?
Actually, Fannie and Freddie don't own that many complex instruments. They do, 75% of their book of business is very straightforward. Yes.
It's criminal that we have to go, but we got to put another break in before the top of the show. So thank you for coming.
Sure.
And sharing this with us. Bill Ackman.
Slides available to the public.